like to call the Linn-Mar Community School District Board, School Board meeting to order at 7 o'clock here in the boardroom of the LRC. Can you please determine a quorum?
Buckles.
Here.
Eisenberg.
Here.
Lawson.
Here.
Maury.
Here.
Nelson.
Here.
Walt. And Weaver.
Here.
Quorum is present at 7 o'clock.
Okay.
I move to adopt the agenda as presented.
Okay, Clark and Britt, did I hear? Okay, next we have the audience communication, and I was informed that there was nothing shared, so we will, as far as online, I think. So.
Do we vote on the agenda?
Pardon me?
Do we vote on the agenda, or just get a second, a motion and a second?
Oh, I did not. Let's
Wanna
vote
make
on the
sure.
agenda, everybody. All those in favor say aye.
Aye.
Opposed? Thank you, Shannon. All right, so audience communication, as far as coming ahead of time like we've asked, there is none. So go on to our informational reports. I was in charge of the Marion City Council report for September 17th, and two or three things stood out to me. First of all, there was a community equity task force established, and along with that, one of the members is Linn-Mar's own Janisa Carr. She was appointed as a representative of the Marion Alliance for Racial Equality, or Equity, excuse me, to this task force. So that's nice that she'll be a representative as part of that. Also, they're continuing to do the city cleanup, and the only other thing that the whole meeting was about mostly was moving forward with building the new public library. It sounded like maybe October 1st might be the groundbreaking if things go well. So they were accepting bids and getting that all organized. So that was pretty exciting. So that would be my report. Next, we have JT for the financial business. We have lots of updates tonight. So thank you, JT.
Good evening, everyone. I am here to review last year's financial numbers. I know we're up and running here in 2021, but we still have to look back and kind of see how things went last year. If you remember, even though our fiscal year ends June 30th, our books do have to stay open 2 months after, so technically our books can't close until August 31st at the earliest. So with that process, we have several reports that are due to the state. Typically that due date is September 15th, but the state did have some issues this year with some of their IT stuff, so that due date got extended to September 25th. I can assure you all the reports have been certified and by the deadline, so again, this is just kind of review of those reports. So just anytime I get in front of you, I like to review the funding buckets, so we'll go over that just briefly. Talk about the concept of fund balance for spending authority, and then go over the kind of the 4 reports that I mentioned: the CAR, the special ed supplement, the LEP allowable cost report, and then the annual transportation report. So buckle up, here we go. Overview of funds. As you know, we still operate under what's called Dillon's rule. So basically, we can only do what the law says we can do in each particular fund. The 4 or 5 funds there in yellow are our property tax levying funds. So when we do our certified budget and put our total property tax rate together, those are the funds that make up our overall tax rate. I won't spend a lot of time on this, but I know it should be reviewed for most of you, but obviously if you have questions going forward, either tonight or anytime, feel free to email me or contact me about that. So now, fund balance versus spending authority. When we talk about fund balance, think about cash. If you have a checking account, similar to a checking account, cash goes in, cash goes out, balance it every month. If you're not doing that every month, I highly recommend that you do that. So it's a measure of cash at a certain point in time. We use that to calculate our solvency ratio. It can be negative and not violate the law, because if the district gets into a financial pinch from a cash standpoint, we can always borrow money to cover the shortfall. And this concept of fund balance applies to all of our funds. When we start talking about spending authority, think about your a credit card limit, or if you're into sports, think salary cap. It's the amount of money that, the maximum amount you can spend at a given time. So it's set forth in law, and it only applies to a district's general fund. So as I've said before, it's an accountant's dream. We basically get to keep two sets of books, one for cash and one for spending authority. However, if you do overspend your authority, that's a violation of state law. Not sure if you've seen in the news here lately with Davenport Schools. Their superintendent and CFO positions were temporarily suspended because of them partially for them violating their spending authority. So they've been dealing with that for several years, and now they've basically been sanctioned by the state for that. Spending authority, it's basically determined through the school foundation formula. So the majority of our spending authority comes from our enrollment and supplemental state aid. Those are the big components of our spending authority. And like I said, it only applies to our general fund. So with that, we'll kind of talk a lot about the general fund here in the next few slides. And also, just a disclaimer, these numbers that I'm going to present, they're not audited yet. Our auditors are coming in a couple weeks to start their final procedures. And then we'll go through that process, and they'll have a final report to the board in December with their findings. So on the revenue side, we finished 2019-20 with total general fund revenues of just under $89 million. That is a little bit less than what we had budgeted. We had budgeted $89.6 million, but as I mentioned to the board in April, obviously with COVID, certain things were suspended, so we didn't get some revenues for like admissions to certain things, fundraisers of that nature. And then the big one was Medicaid. We were not able to qualify for a lot of our Medicaid revenues for that closure period. So that is one of the big reasons why our revenues were less than budgeted for last year. On the expenditure side, just under $87.8 million. And you can see the breakout of the expenditures. 82% of our budgeted expenditures come from salaries and benefits, just over 82%. And then purchase services, that's going to be like our utilities, it's going to be our open enrollment, tuition payments out to districts. And then that AEA flow through, if you remember from prior conversations, the AEA gets a portion of dollars that just flows through the district. We don't actually see that money come in our books. It's basically just a journal entry, but it's, again, we still have to account for it though in our books. So that's our total expenditures, and we had budgeted $89.6 million for expenditures, so we were well below our budget expenditures, which obviously is a good thing. And you'll see that net result here in a second, which is where that arrow is. If you look at that arrow and that change in fund balance, when you take our total revenues and subtract our total expenditures, black numbers are good. Just under $1.2 billion surplus in our general fund in the year. So our fund balance did increase by that $1.2 million. So our total fund balance in our general fund is just over $11 million. So that is good news. Very, very little good news here during this COVID time, but this is one of them. So the reasons for that, as I mentioned on the revenue side, it's primarily property tax and state aid, which is driven by our formula. So our enrollment was up 120 kiddos, and supplemental state aid was up just over 2% for last year. So our revenues did increase. However, on the Medicaid side, we received $500,000 less than what was budgeted. And then some of our local revenues, like I mentioned, interest, student fees, rentals, fundraisers, certain admissions were less, about $150,000 to $200,000 less than what we budgeted. But overall, our revenues were up 2.7% from the previous year, so that was a good thing. That was one of the reasons why we did, in the fall when COVID hit and we were closed, that's why we did, the board made the decision to pay our folks, because we had received where we're going to receive our primarily revenue sources, which again is state aid and property taxes. On the expenditure side, salaries and benefits did increase, but they were less than what we expected due to COVID. We had less sub costs. We didn't have as many extra trips for bus drivers. We didn't have overtime from that mid-March till the end of the school year. And also we didn't have any hours worked above contract. So that was about $900,000 to $1 million less than what we had budgeted when it came to salaries and benefits. For supplies and equipment, a lot of the supplies and equipment costs were down. Copies, instructional supplies, our maintenance. We didn't have to buy as much toilet paper, for example, because we didn't have folks in our buildings. Utilities were down as well because our buildings were not occupied, so we adjusted our thermostats accordingly. So that resulted in just over $800,000 less expenditures than what we had expected. So overall, our expenditures were up 1.2%, but as you can see, we did budget a 3.5% increase, so we were well less than what we budgeted. Yes, Karen?
For the Medicaid less than budgeted, I assume that is because we have like less reimbursable items, so our expenses in that category were also down, or?
Yes. Our Medicaid expenses were down because they have to reconcile. So
Right.
Yep, there's a net.
So
zero.
is that like money in and money out, like if we're not spending that money that would be reimbursed by Medicaid, is it still impacting, like, I guess, how would that work?
Yeah, because we didn't get as much Medicaid revenue and more of our special ed expenditures that are technically just, they're not covered by that revenue source.
Okay.
So you'll see later on in the presentation, it's one of the reasons why our special ed deficit
Is even greater?
did increase.
Okay.
Yep.
Thank you.
Good question. When we look at our general fund financial metrics, this is set forth in board policy 801.4, and basically it says our solvency ratio and our unspent balance ratio will not go less than 7%. Because we did see a positive change in our general fund, you can see both the unspent and solvency ratio did increase by about 1% in each category. So again, that is good news. It's a good trend to have.
I have another question.
Yeah.
I'm sorry. This was, I told you I wrote them down ahead of
Yeah.
time. So this one, we were expecting the trajectory of this metric to continue to trend downwards, closer to 7%. Do you anticipate kind of like a change in direction that will lose that 1% going into the 2021 school year? Because we were kind of starting to talk about what if we get to that 7% in 2019, so.
Yeah, I think that it will go down. Obviously, putting 2 new buildings online, our expenditures are going to increase substantially. I haven't been able to do the 5-year projection, and trying to put COVID expenditures in there too has been a difficult,
Right.
difficult exercise. So hopefully here in the near future, I can bring, at least to the finance audit,
Yeah, that would be great.
a better 5-year projection, but I do expect that to trend back down
Okay.
next year. And then especially with just the unknowns with the state, we're fortunate to have 2.3% SSA this year. Highly unlikely that number is going to be
Yeah, and that
anywhere
could
near that.
significantly
So
impact that.
That's going to be a huge factor in all of this budget planning. So, yeah, good question.
I only have 2 more good questions so far.
You have
Not for that
not for
slide.
that? Okay.
Stay tuned.
Stay tuned. All right. So as I mentioned, our fund balance in the general fund is just over $11 million. And within that $11 million, there's restricted dollars, assigned dollars, and unassigned dollars. The restricted is basically the state categorical money that we get. And there's TSS, there's TLC, there's early literacy, all of those different categoricals. Again, we spend those how the law dictates us to spend that. If we don't spend it, then we carry that money over. So this is basically that restricted dollars is carryover of state categorical money. There's about $120,000 of early literacy dollars that are carrying forward. just over $400,000 of professional development money, and then another about $400,000 of TLC. And again, we anticipated the TLC because with the new buildings coming online, we added positions to that, so that fund balance for TLC will continually decrease over the next few years. Before I move on to the other funds, is there any questions about the general fund at this point? Kara?
No. That's for the other, my questions are for the
Gotcha.
other funds.
Gotcha. All right, so we'll move on to the student activity fund. As you know, the activity fund is comprised of various athletic club and other activity accounts. Each of these individual accounts is required to maintain a positive balance at the end of the fiscal year, and they all do. But what you can see is there's a large decrease in revenues specifically and expenditures due to COVID. If you compare last year's number, it's a little misleading because last year there was a large band trip, about $450,000 of revenues and expenditures. So that's why that number was fairly large last year. But if you take that out, our revenue still decreased by about 32, 33% when factoring in that adjustment. So again, a significant blow, if you will, to the activity fund, just with the loss of activities and things that occurred due to the COVID closure.
What do you anticipate the impact being? Like, where will we feel this 32% decrease in revenues?
I think it's going to be felt in all of our activities in some capacity, because basically how we run our activity fund, it kind of goes all into one big activity fund pot, and then our athletic directors or Cam Belt or whomever, they kind of allocate it to the different activities. So it's going to be felt by each activity in a certain way, at least with the admission revenue that comes in. Now the fundraisers are going to be different with each group, because some groups may choose not to do fundraisers, some may choose to do fundraisers, but again, some of the fundraisers that they've done in the past are not necessarily COVID,
Oh, yeah, right, exactly.
so it's really hard to tell, to be honest with you. But I think what we do know is the revenues are going to be down.
So
again.
I guess going into this, my thought would be that we should be conscious that this impact is felt universally against all different types of students' activities, and that there isn't like any particular activity that is kind of shielded from this loss of revenue. And then is there any flexibility? I know that safety equipment is one of those pieces that we can kind of use to move money around from different funding buckets. Do you feel like we'll be able to do that to kind of compensate for this loss at all, for some of equipment that is needed? And
We've done that even without COVID, so we'll continue to do that if necessary. If there's more safety type items that different activities need, absolutely we'll consider that. The CARES money that we got could potentially be used for not to replace revenue loss, but it could be used to for COVID related type expenditures. But unfortunately, that money isn't going to last long. So I don't really anticipate that there will be money to be used for the activity fund for that. But that would probably be the only other option. Other than that, there's really no way. The board can't say, hey, we're going to take, $200,000 of general fund money and transfer that. It's just not. Again, we
right,
operate.
it has to fall under those
Yep.
pieces. Okay.
Yep.
Thanks, JT.
Management fund. We'll talk a little bit about this more later on in the agenda with early separation, but the revenue decrease in this fund purposeful. We decreased the overall levy because we were allocating more tax dollars to the general fund. So we knew that the revenues were going to decrease here in our management fund. And then we did have a expenditure increase due to our property liability insurance premiums, as well as workers' compensation, and then again, early separation costs. increase our expenditures from the previous year. But again, this is not, we kind of knew this was going to happen. We had a very healthy balance in the management fund, so again, we made that decision to allocate more dollars to the tax dollars to the general fund for this fiscal year, or last fiscal year and this fiscal year. So
Do we anticipate significant insurance expense increases after the claims from the derecho?
that's probably a good bet, yes.
Like, do you think it will be significant, or?
It depends. The insurance folks that I talked to said that they look at natural disasters a little bit differently.
Right, because
So-
it's not outside your control.
Yeah, so I think it'll be an increase, but maybe not as much as,
Hopefully.
hopefully, yeah.
Thanks. I didn't have that one written down. It was a bonus question for you.
Thought I was in the clear.
No.
Pearl, Public Education Recreation Levy. This is another property tax generating fund, 13.5 cents. And the expenditures increased. We're kind of building that fund up because we knew we were going to build the track out at Oak Ridge, and that project has started in May. It's still ongoing, by the way. Hopefully, they'll get that done here in the next few weeks. But anyway, that's the reason for the fund balance and the expenditure increase in Pearl. SAVE, otherwise known as sales tax. As you know, basically sales tax dollars are collected at the state level and then allocated to districts based on certified enrollment. It's just over about $1,000 per kid. So again, it's based on certified enrollment. I think some people think that, hey, if you shop local, which again, shopping local is obviously a good thing, but that money doesn't directly go to Linn-Mar. It goes into the big state pot, and again, it's allocated based on our enrollment. But again, support our local businesses. We need to do that. If you look at our revenues and expenditures for fiscal year 20, there's $15 million that's related to our bond issuance that we did in May. So just factor that in. When you compare it to last year, that's the reason for the big increase in revenues and expenditures because of that bond sale.
Has the state issued any change in projections anticipated as a result of COVID? Have they said that sales tax dollars are trending down, and how's that impact?
Another good question. We got our estimates for fiscal year 21, and actually it was pretty stable compared to
Okay,
prior
good.
year, so we didn't see that impact yet. It'll be interesting to see what happens the following year. But obviously, now that online sales have been starting to be taxed, that's made a big impact and helped mitigate some of that. So again, good questions. So there's a $6.7 million fund balance here for sales tax, and of that $6.7 million, 3.8 is required to be in reserves from previous bonds that we've issued. We had to put in our non-private placement bond issuances, which was basically before 2015, we would have to set aside reserves to make for financial institutions to ensure that we would be able to cover our, to give them assurance that we would cover our principal and interest payments. So we've got $3.8 million in CDs basically that are just kind of sitting there until the bonds are actually paid off. Some of the expenditures in SAVE for last year, we had $1.2 million in technology. There's $500,000 related to the Wilkins project. And then the majority of our expenditures relates to our previous, again, bond sales, about $5 million of principal and interest for sales tax. And then as of June 30th, we have just over $54 million of sales tax debt outstanding. Pebble, another tax levying fund, $1.67. Of that, 33 cents is board approved, and then the $1.34 is voter approved Pebble tax dollars. So that's what makes up that $1.67. Some of the expenditures for last year, principal and interest of $1.2 million, We had borrowed money for the high school renovation several years back, so that we're still paying on that. And then Bowman Woods project, Indian Creek project, high school roof and HVAC project, and then just over $500,000 of buses and other vehicles last year. One thing I'll point out, if you look at our revenues, it increased substantially from 3.7 million to 4.8. We received a large hail claim right at the end of the year of about $900,000, which is a big dollar amount. That will pale in comparison to what we're going to get with this land hurricane, but just note that that's the reason for that large increase in revenues. And then we have $5.8 million of PEPAL debt outstanding as of June 30th. Other capital projects. So if you recall, in 2019, in the fall, we sold general obligation bonds, and $47.4 million of that was transferred to this fund. And then again, we had the sales tax bond sale in May of 2020, and that was transferred to this fund as well. So total revenues of just over 62, or just under $63 million, because there's some interest earned on that money. As far as the expenditures go, again, the big projects, Hazel Point and Boulder Peak, account for $52.6 million of those expenditures. We purchased land for about $2 million. Bowman Woods project, roof, $500,000. Ongoing Wilkins project, $300,000.